Hello class, this is Dr. Fenton. In this video, we are going to talk about long-term liabilities in Chapter 9. So let's get started. Now there are various types of long-term debt, and we will see here that debt is where you owe money to creditors. Okay, I think that's fairly understood. There's also another way to finance a company, and that's called equity financing. So if you think about the balance sheet, you have assets on the left side, and the way I always look at it is that on the right side, this shows you how those assets were financed. There are only two options to finance the business, either debt or equity. So liabilities or stockholders' equity. So we're going to look at liabilities in this chapter. Now, one reason a company would like to finance itself with debt is because the interest that it pays is tax deductible. Now, if you finance the company with equity, selling common stock, then at some point the shareholders would like to have some dividends paid out of the company. Well, the company does not get a tax deduction for dividends that it pays. So there is a tax benefit for having debt. If you can handle the debt and make the payments for interest and the principal, then debt is okay to finance a company if you use the debt wisely. Let's first look at installment notes. And these are notes that you might be experiencing yourself, like a car loan, house loan, or something like that. Now, each payment, and usually these are monthly payments, each payment is broken out into the principal and the interest. So either you're paying down the balance on the loan, that's the principal part, or you're paying the interest, and you pay both of those with each payment. So our example here is we have a $25,000 6% 4-year loan for a new truck. The payments have been calculated for us, and they are $587.13 a month. And they'll pay that at the end of each month for 48 months. So this is a typical car loan. Here is an amortization schedule that the bank or the lender can easily hit the print button and print out for you. But this shows you for each payment how much of the payment is principal and how much is interest. Now notice, just like our house loans and car loans, the cash paid each month, the payment each month is the same. This doesn't change. And this is really shortened. They don't show every month in here. This is like 4 years worth, but they took out quite a bit. They show the loan date, the first couple of payments, a year later the balances, and so forth. Now the interest expense, we'll see how to calculate this in just 1 second, but here's the amount calculated for us for interest for each payment. Here's the what they call decreasing carrying value. I wish they would use different words here, because this is the decrease in the loan balance itself, okay? And the carrying value is the actual loan balance. So if you borrow money on November 1st, 2021, there's the cash that came in the door, that's the amount of the loan. A month later, you make the first payment, $587.13. The bank will record this as it comes in, your one check. It will show interest at $125, and it'll show the reduction of the loan balance of $462.13. So right before this payment, the loan balance was $25,000. Again, they're using the term carrying value, but that's the loan amount. Now, if you pay this payment, $462.13 is going towards the principal of the loan. So after this payment, your new loan balance, your new principal balance is $24,537.87. So $25,000 minus this amount going towards the principal. They call this decreasing carrying value. Again, this just means the amount you're paying towards the principal. So your carrying value or your loan balance drops. After the next payment, it drops even more. So each payment, your loan balances drops. And so when you make that very last payment 4 years later, then you see very little is interest, quite a bit is the loan balance, and then you've paid the last amount and the loan balance is zero. So this happens with every car payment, with every house payment. Now, how do we get the interest expense? Okay, the interest expense is always the principal, the remaining loan balance, times the interest rate, and they said here it was 6%, times the time period, which will be 1 over 12, 1 month over 12 months. So again, this interest expense is this loan balance, because you haven't paid it yet, so the balance is still $25,000. So it's $25,000 times 0.06, 6%, times 1 month over 12. That gives you $125,000. Now the next payment a month later, your loan balance has decreased. So this is the new principal. So it's $24,537.87 times 0.06 times 1 over 12 for 1 month, and the interest is lower because the loan balance is lower. So the interest is only $122.69. The payment is still the same. So you have a little bit more, about $2 more going towards the principal. So then you take this amount going towards principal from this, and here's the new principal amount, the new loan balance. You'll do that every month, for 48 months. And again, this is your last payment, same dollar amount. Very little is interest because you have a very small loan balance at this point, almost 4 years later. So if you take $584.21 times 6% times 1 over 12, you'll get $292. Subtract that from the amount you're writing the check for. This amount is going towards principal, so it knocks the loan balance down to 0. Okay, so you can read all through this. Here are the entries for this. I want you to know the entries. On November 1st, when you first receive the cash that you're going to use to buy the truck or whatever, cash comes in $25,000, notes payable $25,000. When you first borrow the money, there's no entry for interest, so don't worry about that yet. Let's go a month later. Now we're going to make the first payment. Cash going out the door, credit $587.13. Interest expense $125. Notes payable difference. You're lowering notes payable. You're lowering the amount of the loan, $462.13. The next month, here is the next entry. Same cash going out the door. The amounts change a little bit less interest expense, a little bit more going towards the principal. So these numbers here are coming from this, what they call amortization schedule, right in through here. First payment, second payment. So I do want you to know how to calculate these numbers for at least the first 2 payments. So make sure you go back and review this. I do want you to know the entries, so make sure you can make these entries. Now, something else to throw into here. At the end of 2021, the loan balance is $24,073. We need to split this up between current and long-term, because we know that we have current liabilities on the balance sheet. That shows how much we have to pay within the coming year, and the long-term debt is the amount after 1 year. So what we'll do right here is they say the current balance is $5,757.78. Where do they get this? Let's go back to here. Oh, look at these numbers: $24.73, $18,315. Go back to the amortization schedule, and here are the 2 numbers. So at the end of 2021, in this amortization schedule, you can see the loan balance is $24,073. That's the total amount to be paid at this point. And a year from now, 2022, the loan balance will be $18,315. Subtract and find the difference, and that is the amount that's the current portion. So this is the long-term portion as of the end of 2021, and the difference is the current portion. That's what they're doing right here with these numbers. Next page. Leases, not a lot to worry about here. I think you know what a lease is. You might lease a car instead of buy it. You might lease a building, in other words, rent the building. So there's nothing here to worry about. That's about all I need you to know. Okay, next page. Bonds. Now here's a big section here. Now, a bond is a formal debt instrument. And a bond is a way for a corporation to borrow a lot of money. Usually bonds are in the multi-millions of dollars, multi-tens of millions of dollars, maybe multi-hundreds of millions of dollars. So it might be hard for a corporation to find one lender, one creditor, to loan all that money to that corporation, because that's a lot of risk that one lender would be taking. So what corporations will do is sell bonds, and so they can break these up into smaller amounts and sell to individual investors. So the investors might buy a $1,000 bond or a $10,000 bond, but if you have a lot of investors buying a lot of these small portions of the bond, then the corporation can raise that let's say $100 million that it needs. Okay. So make sure you read what I have highlighted here. The issuing company, the borrower, receives cash by selling a bond to an investor. Now, the investor, the lender, the investor, is supposed to receive two things. The company's promising to pay the investor, first of all, a stated amount referred to as a principal or face value at the end of the life of the bond. The bond could be 5 years, 10 years, 20 years, but the investor is going to receive the face amount, the principal amount of that bond back at the end of the life of the bond. But in addition to that, between the issuance date of the bond and the maturity date, which again could be 10 years or so, the investor will receive periodic interest payments. Usually they're received every 6 months. So the investor is expecting an interest check every 6 months, for 10 years or 5 years, whatever the bond maturity life is. And at the end of the maturity date, then they will receive the face value or the principal amount of the bond. So the investor has two income streams. The receiving of interest, this is not an installment note. So this is not a payment with part going towards interest and part going towards principal. This is all interest every 6 months. Then at the end of the maturity date, then the full face value is paid back. The 10 million or the 100 million, whatever the face amount is. Now, as I said earlier, the bonds are formal agreements. So it's a lot of paperwork involved, a lot of underwriters involved. They have the face value, they have the stated interest rate, they have the terms. So it's a quite complex document. But these are sold all the time, though, by the major corporations. There are a variety of bond characteristics that could be there. A bond could be a secured bond or unsecured bond. So if it is a secured bond, then that bond issue is backed by collateral, which could be buildings, equipment, land, some asset the corporation has that it's saying, if I don't pay you the interest and the principal of the bond back, if I don't make my payments, then these assets will be sold to pay you back. An unsecured bond, there is no collateral. You're just taking the good faith credit of the corporation. A term bond means that all the little separate bond issues being sold, part of the big bond package, they might be maturing at different dates. So you might have a bond issue where part of the bond comes due in 5 years, part of it comes due in 6 years, and so forth. So you have different maturity dates. That's for the serial bonds. The term bond, there's only one single date. Okay, so anyway, I think I switched that around. The term bond, there's one single maturity date. Serial bonds, there are a series where part of the bond comes due at the end of different years. A callable bond, a corporation can call the bond back and pay it off early. It might do this if interest rates drop, so it can sell more bonds at a lower interest rate and pay off the old bonds. And then finally, convertible bonds, the investor may have the choice, and this is their option. They don't have to do this, but the investor may be able to convert the bonds to common stock. So the bond document will state which one of these characteristics are applicable to that bond. It's either secured or unsecured, not both. It's either term or serial, and then it could be callable and convertible. Okay. So here's our longer definitions, all those terms. You can read that. So let's look at an example. Let's say we have a California Coasters Corporation on January 1st, 2021. it issues, in other words, sells, in other words, receives cash of $100,000, and it will pay 7% at an annual rate. The bonds are due in 10 years, interest payable every 6 months, June 30th and December 31st. So the face amount, sometimes called the principal amount, $100,000. That'll be paid at the end of 10 years. Interest payments, $3,500 every 6 months. So this is the principal, the rate, 0.07 times 1/2 year, or 6/12, same thing, but this is 6/12. And that's $3,500 every 6 months, or $7,000 a year. But if you go for the 20 interest payment periods for 10 years, the corporation then will pay $70,000 in interest total over a 10-year period, and it will pay $100,000 face value back at the end of 10 years. A little chart just explaining that. And next page. Let's look at the entries. So that same example, issue bonds, $100,000. So debit cash, $100,000, and credit bonds payable, $100,000. This is a long-term asset. Again, this is when the bond is sold. In other words, the corporation is receiving cash. It is borrowing money. So bonds payable. No interest to be recorded on this date, on January 1st. Now the interest expense is going to come into play on June 30th, 6 months later. This is the first interest payment period. So on June 30th of that year, 6 months later, we're going to pay cash. The corporation paid cash at $3,500. Again, that's the $100,000 face value times stated interest rate, 7%. Don't forget to convert that to 0.07 times 1/2 year. So $3,500 is the cash the corporation is paying the investors, and we're going to record that as interest expense because that exactly is what it is. Now, this same entry will look exactly the same every 6 months. It's not an installment note where we have part principal, part interest. In bonds, it's always interest every 6 months. So every June 30th, every December 31st, for the next 10 years, this entry will be exactly the same. Now, let's add something else to this discussion. There is a bond market just like there's a stock market. And interest rates go up and down really daily. You're always hearing about mortgage interest rates, and they'll talk about they're going up a little bit, like 1/4%, or down a little bit. They vary daily themselves. Same way with the bond market. The interest rate is called the market interest rate, will also go up and down. So if the corporation wants to borrow $100,000, it starts the paperwork. It's going to take months before everything is signed and the bonds are being issued. In that time period, even though the corporation has in the bond document a stated interest rate, the market rate for that type bond, for that type corporation, the market rate of interest could be higher or lower. It's rarely exactly the same when the bonds are actually sold. And so the market rate of interest depends on the default risk. And the default risk refers to the possibility that a company will be unable to pay the bond's face amount or interest payments as they become due. And so the riskier the corporation is, in other words, it's not in great financial shape, then the investors are going to require a higher rate of return on this investment. So they might require a higher market rate of interest than the stated rate of interest. In the previous example, the stated rate of interest was 7%, and without telling you, we assumed the market rate was also 7%. And so the bond was sold, as they say, at face value. It was a $100,000 bond, and the corporation received $100,000 cash when it sold the bond. But here are, make sure you look at this. This is a very good multiple choice question. I want you to know this. If the bond's stated rate of interest is less than the market rate of interest, then the bonds will be issued below the face amount. It's called a discount. Now, If the bond's stated rate of interest is more than the market rate, the bonds will be issued above the face amount. It's called a premium. So if the bond stated rate is less than market rate, the corporation will not be able to sell the bond at the face amount. It'll have to sell it for less than the face amount. And opposite with the premium. Stated rate's more than market rate. So let's look at this. Let's look at a discount example. The bonds, these bonds, going back to our original example, they have a stated rate written on the bond instrument of 7%. That doesn't change. But by the time this was implemented and put into the bond instrument, and before they were sold, then the company's higher default risk had investors concerned. So they say, okay, in so many words, if I'm going to loan you this money, California coasters, I would like a return of 8%. Now, I know your bonds state 7%. I know you're going to pay me the $3,500 every 6 months. I know you're going to pay me $100,000 at the end of 10 years, but I want the price adjusted, so it's going to work out to where I earn 8%. So we have to discount these bonds. We'll see later how to discount the bonds, how to calculate this. But let's just say, for example, the bonds were sold for $93,205. If that's the issue price, that's the cash the corporation is going to receive. So we debit cash $93,205. We still credit bonds payable, the long-term liability, $100,000. The difference is called discount on bonds payable, which then everyone will know that these bonds were sold for less than face value. They were $100,000. The corporation was trying to raise $100,000, but the investing public demanded from this corporation an 8% return, so we had to adjust the price of the bond. So it's only $93,205. So we do record this new account, discount on bonds payable. Call it exactly what it is. And also, it is a contra liability account. So in the long-term liability section of the balance sheet, you'll see bonds payable, $100,000, and then less discount on bonds payable, and there's the discount amount, $67.95. And the carrying value that'll be added to the other liabilities is the $93,205. Even though these bonds were sold at a discount, the interest payment is the same. This is where it gets a little bit confusing. The corporation will still pay the stated interest rate, 7%, on the face value. Now, I know the bonds were sold for only $93,205, but the interest calculation is the same. It's always the face amount times stated interest rate, not market rate, times a half year. This is the cash paid. Now, a little bit more confusing is to calculate the interest expense, because you would automatically think, well, if I'm paying interest of $3,500, that should be the interest expense recorded, but not in this situation. This is the cash paid, but the interest expense is different. The interest expense is the carrying value of the bond times market rate of interest times a half year. Okay, look at that again. The carrying value, not the face amount, the carrying value times market rate, not stated rate, times a half year. So even though we are going to pay out $3,500 in cash, and you can see the entry here, cash paid out, credit $35. Even though we pay this, we are going to record interest expense of $37.28. And the difference then is going to be a credit to this discount account. Now we're going to start to write off this discount account. And just find the difference, subtract. So $37.28 minus 35, plug in this number, $228. So that means we are starting to reduce the bonds payable account. The discount on bonds payable account. A little bit later, 6 months later, again, here's the amortization schedule for 6 months later. We're still going to pay $3,500, but the interest will be a little bit different because the interest here is now the new carrying value. Watch closely. The new carrying value right before you make this entry on December 31st. So it's the 93,205, 93,205 plus 228 times 8% times a half. A better way to see how this is calculated is really go to this carrying value after the June 30th entry, 93,433. Take that times the market rate 8% times a half, you get the same number. This is a little bit confusing here, and if you have the amortization schedule, they've already taken this. They've already taken the 93,205 plus 228. So 93,433, the carrying value right before the entry we're trying to compute here. So 93,433 times 8% times 1/2 gives you that 37.37 interest. Cash still the same. Find the difference. So 237 is now the reduction in the bonds, in the discounted bonds payable account. That's about all you need to worry about on bonds, on how to calculate these first couple of entries for a discount and also for a premium. We'll see that right here, a premium. Now for a premium, here's where the stated rate is more than the market rate. So the market has become more favorable to the corporation, but again, it takes months of paperwork to get these bonds sold, and they already have committed to a stated rate of 7% on the bonds. But if the market rate is 6%, then the corporation doesn't need to pay 7%. That means it can sell the bonds for more than face value. So if we sell the bonds for $107,439, here's the entry. Debit cash, the total amount, credit bonds payable, face amount, and then credit premium on bonds payable, call exactly what it is for the difference, $7,439. This is the way the long-term liability section would appear on the balance sheet. Bonds payable 100, add the premium, carrying value 107,439. Now, again, like it says in here, even though the corporation is selling these bonds for $107,439, it is still only going to pay back $100,000 at the end of 10 years. So when you take that into consideration, then it'll pay only a 6% return on the bond and not the 7% the stated value. Interest, the entries here, June 30th, first payment, cash, still $3,500. So it doesn't matter if the bonds are sold at a premium, at a discount, or at face value. The cash going out the door is always the face value times stated rate times a half year. Interest, cash payment doesn't change. Interest expense does. So this is the carrying value times market rate of interest times a half. The expense is only $32.23. And the difference, we're going to start to lower the premium account to $277. And you can see the entry on December 31st, again based on the amortization schedule here. On your exam, I'm not going to have you prepare an amortization schedule like this. I might have you make an entry or two for bonds, but you don't have to prepare the amortization schedule. You'll have to know how to make the calculations for these, but not a formal amortization schedule. Here's a graph just showing what's happening. If you issue the bond at face value, then the carrying value is always the same, $100,000. If you issue the bonds at a discount, the carrying value starts less, but then as we write off, as we lower the discount, the carrying value starts rising, and on the maturity date with that last interest payment entry, the carrying value will equal the face value, 100,000. Premium, we start with a higher carrying value, but we start writing that off with each payment that we make, each 6-month payment. And after that last 6-month interest payment, the carrying value will equal $100,000. So no matter where you start, at the maturity date, right before you pay the full amount back to the investors, after that last interest payment, then the carrying value is equal to the maturity value. And the entry would be debit bonds payable $100,000, credit cash $100,000. That's the entry you'd make at the end of 10 years. Again, debit bonds payable, clear that off, credit cash $100,000. And here's a review. You can look at this yourself. Retirement of bonds payable. I just mentioned this entry. At the end of the life, it doesn't matter if you issued initially the amount at face value, a discount, or a premium. At the end of the life of the bond, here 10 years later, here's the entry. Okay. Don't worry about this section here before maturity. And nothing there. And the next page. Let's see how to find the selling price of a bond. Earlier, if we sold the bond at face value, there's no calculation. $100,000 is what we received in this example here. If we sold the bonds at a discount or premium, then someone has to calculate the price of the bond. Let's see how to do that. We're going to use what's called the present value tables to find the price of a bond. So let's go down to the discount example. Let's see right here. They show you here how to calculate this using your calculator. I guess since calculators are different, I'm not going to go through this part here. I'm going to use the tables. Okay. So remember this number, 93,205. This is the amount we received for the bond when the stated rate of interest was 7% and the market rate of interest was 8%. And that's a per year and annual interest rate. Now, what we need to do is find the present value of the face value of the bond. So $100,000, 10 years in the future, what is that worth today? Well, in this situation, we have two things going on. We have those 6-month interest payment periods. So we're going to make this 20 periods within the 10-year period. So we're going to double the number of periods when we look at the year. So 10 years, 20 periods, N means 20 right here. Then we're going to take the market rate of interest, which is 8% a year. Every 6 months, that's only 4%. Now, these numbers should look familiar to you, face value. The cash payment is going to be received every 6 months. So what we need to do is find these factors from the present value tables to help us find the price of the bond. So we know these amounts. We need to find from table 2, I'll show you how to find that in a minute, the factor for 4% interest, because it's 4% every 6 months, and there are 20 6-month periods in this 10-year bond. And since this is a one-time payment, it's going to be the present value of $1 in the future. And we'll take that times $100,000. Now this, you can see this factor is larger because this represents an annuity. We're going to be paying $3,500 every 6 months, so 20 times over the 10-year period. So we're going to look at the tables. We're going to find the 4% column and the 20 period row in two different tables. The first table, table 2, will be for a one lump sum payment at the end of the term. Table 4, payments periodically for 20 periods all throughout the term. Let's find the tables. And we're going to find these two factors right here, 0.45 something and 13.59 something. Let's see how to do this. We're looking at 4%, 20 periods. So go to your table of contents, scroll down to future value, present value tables. Let's go to the tables. Now, table 1 is future value. We are looking for present values. So let's go to table 2. Remember what we were looking for. 4%, 20 periods. Let me try to bring this back up a little. Kind of hard to do. Well, it's not letting me stop right where I want to anyway. Okay, so 4%. Let's go down this column. We're not there yet. We're at 15 periods. So let's stay in this column right here. And here at 20 periods, that's the number. Okay, this is under the 4% column. I cannot get my screen to stop where you can see both the interest rate up top and the number of periods. But this is the factor we were looking for, 0.45639. Again, this is for that one payment out into the future. What is it worth today? So it's a lump sum payment. Present value of $1. Now table 4, this is the present value of an ordinary annuity. This means the same amount every period. So we still use 4% every 6 months. We need 20 periods. So I need to come down a little bit more. Right here. Well, this let me do it. 4%, 20 periods, there it is. 13.59033. That's where we get the factors. So make sure when you go to these tables, use half the market rate of interest, half the 8% in this example, and use the number of interest payment periods, 20, because it's a 10-year maturity date, but 6-month payments, so we have 2 a year, so 20 interest payment periods. So let's go back to where we were, back to long-term liabilities, and we were down here. And so here is the result. That's how we find the price of this bond when it's sold at a discount. $100,000 times that factor from the present value of $1, one lump sum in the future. That's worth, in today's money, $45,639, present value of that future amount. Now the present value of all those $3,500 payments every 6 months, what are those worth today? $47,566. So today, the price of this bond is worth $93,205 at a market rate of 8%. That's what the investors are willing to pay us, the corporation. That's how we get this number. Do the same thing for the premium. You're going to look up these numbers, and the reason this is 3% here is because in this example, the market rate was 6%. So go back to those same tables, use the 3% column, still the same number of periods, and then you'll see the price of the bond is more than face value because the market rate is less than the stated rate. Debt analysis, a few more things in this chapter. Debt to equity ratio, a very common ratio. Easy to calculate. Total liabilities divided by total equity. So you're looking at the right side of the balance sheet. How much of your business is financed by debt compared to equity? So if you make this division with your numbers, and this number is 1, that means you have just as much debt as equity. Here's some numbers for Coca-Cola and PepsiCo. And Coca-Cola has a debt to equity ratio of 2.76. Pepsi, over twice as much. So Pepsi uses a lot more debt compared to equity than Coca-Cola does. Now they're roughly the same debt-wise, within less than $2,000. But you can see the equity though. Coca-Cola has a lot more equity, so it's only using 2.76 times as much debt as equity. PepsiCo, 5.62. This helps you decide, is this corporation handling or carrying too much debt? Would I want to loan money to PepsiCo as compared to Coca-Cola? A little bit more risky. I'm not saying PepsiCo is a bad company, no. but a little bit more risk involved here because there's more debt compared to equity. Chapter 7, we talked about return on assets. There's the amount you can compute. Look at that. PepsiCo is doing better here. Return on assets, a little bit higher. Times interest earned ratio. This has always been an odd kind of ratio. The title of it seems like it makes no sense whatsoever. What it's trying to do is seeing, okay, do I have enough income from your income statement before you deduct interest and taxes? Do I have enough of that income to pay for my interest? So it's to measure the risk. Are you making enough profit before interest and taxes to pay for the interest? So here's the formula. Take your net income, bottom line, add back the interest, add back the tax. Why? Well, we're trying to see if we have enough income before we pay the interest, so add interest back to net income. And interest is a tax deduction to get to net income, so go ahead and add back tax expense. And that shows you how much, quote, income you have available to pay your interest. And so the higher this number, the better off you are. And looks like Coca-Cola, 12.1 times, PepsiCo, 7.4. So when you look at how much money they have available, or I should say income they have available to pay off the interest, Coca-Cola is in a little bit better position than PepsiCo. Okay, so I think that is it. Chapter highlights, and then you get to the end of chapter material. So quite a detailed chapter. So please go back and read it yourself, follow the examples through, and good luck with your studies.